So usually when you watch a massive public company fail, I mean, it's a painfully slow, highly predictable descent.
Right, it's a grind.
Exactly. The revenues start drying up. The physical stores put up those liquidation signs in the windows. The core assets get quietly sold off for pennies on the dollar. And eventually, the ticker symbol just fades to black.
The standard corporate life cycle.
Yeah.
It's brutal, yes, but it is ultimately grounded in basic financial math. A business that spends more cash than it generates simply cannot survive indefinitely.
But then you step into the 2026 market and suddenly, well, financial gravity just stops working entirely.
Absolutely. We're seeing valuations decouple completely from operational reality.
Welcome to today's deep dive. We are thrilled to have you with us. Our mission today is to unpack one of the most wild, head-spinning corporate pivots in recent stock market history.
It really is unbelievable.
It is. We are looking at the sudden transformation of the struggling, eco-friendly shoe brand Allbirds into an artificial intelligence cloud provider called NewBird AI.
Quite the leap.
Yeah, to say the least. And to get to the bottom of this, we're drawing on a stack of highly detailed sources. We've got their Q1 2025 financial filings, the definitive asset purchase agreement, and press releases regarding a $50 million AI financing deal.
And we also have a really brutal forensic teardown from New Constructs, plus valuation models from Ticker X-Ray.
Right, along with market coverage from The Guardian and MarketBeat.
And look, we're going to approach this exactly the way a hedge fund analyst would. That means ignoring the retail noise and focusing strictly on the actual numbers, right? The structural drivers of the business.
Okay, so let's unpack the sheer absurdity. How does a company that sells sustainable wool sneakers suddenly trigger an 800% intraday stock rally just by putting out a press release that says the word GPU?
Well, to understand the magnitude of this pivot, you first have to look at the cratering reality of their core footwear business.
Oh, it is bad.
It was catastrophic. This wasn't a company operating from a position of strategic strength, looking to diversify. This was a company in absolute freefall.
Yeah, the Q1 2025 financial filings paint a very clear picture of that freefall. Net revenue dropped 18.3% year over year, down to $32.1 million.
Right.
And they posted a net loss of almost $22 million for just that one single quarter. Plus, their gross margins dropped down to 44.8%. For a premium retail brand, those numbers look fatal.
They are fatal.
But I want to understand the mechanism here. What actually broke inside their business model to cause that kind of margin compression?
It's a textbook case of a direct-to-consumer, or DTC, strategy completely unraveling. The original theoretical appeal of DTC is that, by cutting out the wholesale middleman, you keep all the margin.
Right, that was the pitch.
But the reality is that you just become your own middleman. You have to pay massive customer acquisition costs through digital marketing. And then you have to shoulder the burden of heavy retail leases to build physical stores.
So the cost just shifted.
Exactly. Allbirds was forced into heavy promotional activity, meaning massive discounts, just to move stale inventory. At the same time, their freight costs per unit were climbing. The underlying unit economics were deeply broken.
So essentially, every pair of shoes they sold was burning a hole in their balance sheet.
Exactly.
Yeah.
Which explains why their brick-and-mortar footprint completely collapsed.
Yeah, they went on a massive store closing spree. By the time we get to early 2026, they had shuttered almost all of their U.S. full-price stores. They were left with just 2 outlet stores in the United States and a couple of isolated locations over in London.
The data points explicitly to this operational failure. The research firm New Constructs actually predicted this downfall well before the current crisis.
Right, they saw it coming.
They did. They warned that the direct-to-consumer model simply could not scale profitably. They highlighted that Allbirds was generating a deeply negative return on invested capital. The number was negative 45%.
Wait, let's translate that metric for a second. Because negative 45% return on invested capital sounds like finance jargon, but it's actually the smoking gun here. What does that mean in real-world terms?
Well, it means that for every single dollar management poured into opening a new physical store or acquiring a new customer online, they were essentially setting 45 cents on fire.
Wow.
Yeah, they were systematically destroying capital with every growth initiative they launched.
If a company is incinerating money that fast, the end game is inevitable. So in March 2026, Allbirds signed a definitive asset purchase agreement.
Right, the fire sale.
Exactly.
Yeah.
They agreed to sell essentially their entire brand, the intellectual property, the core assets, the shoe designs, to the American Exchange Group. And the total price tag for the entire operation was an estimated $39 million.
And that $39 million figure should stop every fundamental investor in their tracks. It represents an almost unprecedented destruction of shareholder wealth.
This is the part that I think breaks people's brains. I mean, they went from a $2 billion valuation at their IPO in late 2021, hit a $4 billion peak valuation shortly after, and now they're selling the whole brand for $39 million.
It's staggering.
It's like buying a sprawling, custom-built mansion and selling it a few years later for the price of a used Honda Civic. How does over 99% of a $4 billion company just evaporate into thin air?
Well, value evaporates when it was never supported by actual cash flow in the first place. The market priced Allbirds at $4 billion based entirely on a growth multiple.
Pure expectations.
Exactly. Investors were paying for the expectation that the company would eventually turn its massive revenue growth into massive profits. But as new constructs highlighted in their forensic teardown, the true economic earnings of the business were sitting at negative $92 million.
So the growth was essentially fake.
Right. When the market finally realized that the growth was unprofitable, that scaling the business just meant scaling the losses, the growth multiple vanished. And when the multiple vanishes from a company with negative cash flow, the equity gets completely wiped out.
Which makes the corporate governance aspect of the story completely wild. You'd assume that if a management team oversees a 99% destruction in shareholder value, they're going down with the ship.
You would think so.
But looking at the filings, that is decidedly not what happened.
The alignment between management and shareholders here is heavily skewed. While the retail investors who bought into the IPO narrative lost almost everything, the executive team ensured they were financially protected on the way out the door.
Yeah. According to the filings, on March 30th, 2026, the exact same day they announced the $39 million fire sale of the brand, the board quietly approved a $900,000 executive retention plan.
Unbelievable.
CEO Joe Vernaccio gets a one-time $500,000 payment, and CFO Ann Mitchell gets $400,000. And this isn't a performance bonus. This is just a payment to get them to stay on through the closing of the asset sale.
The irony is profound. I mean, management is receiving nearly $1 million in cash to essentially supervise the funeral of the company.
That's exactly what it was.
Because at that point, the original plan outlined in their SEC filings was a complete corporate dissolution. The strategy was to close the asset sale, use the $39 million to settle their outstanding liabilities, and distribute whatever pennies were left over to the stockholders.
It was so fundamentally dire that new constructs actually suspended their rating on Allbirds entirely. Reason? The company's 10K filing included a going concern disclosure.
Right, and a going concern warning is the ultimate red flag in financial auditing. It means the company's own management and their auditors have substantial doubt about the entity's ability to survive for the next 12 months.
It's a death sentence.
Pretty much. Once a going concern warning hits the tape, fundamental analysis is essentially over. You are no longer looking at a functioning business. You're looking at a distressed liquidation play.
So the shoes are sold, the executives are cashing their final retention checks, the auditors are preparing for the end, and the market is waiting for the ticker symbol to be delisted.
Right.
But then, on April 15th, 2026, an absolute plot twist hits the tape. Here's where it gets really interesting. Allbirds announces they've secured a $50 million convertible financing facility from an institutional investor.
Out of nowhere.
And they are not using this capital to design better sustainable sneakers. They announced they're pivoting the remaining public shell of the company into NewBird AI.
Right. The new business model abandons consumer retail entirely. The intention is to become a fully integrated GPU as a service, or GPU-AS and AI-native cloud solutions provider.
Just a total 180.
Exactly. The stated strategy is to take that $50 million, acquire high-performance graphics processing units, and lease them out to capitalize on the massive global shortage for AI compute power.
But let me push back on this for a second. If I'm a shareholder trapped in a dying retail stock that's about to go to zero, isn't this exactly what I want management to do?
How do you mean?
I mean, AI is the most lucrative sector on the planet right now. Compute power is basically the new oil. Isn't securing $50 million to pivot into a high-demand sector a brilliant, desperate survival move compared to just dissolving the company?
Well, on paper, pivoting toward demand always sounds brilliant. But in reality, execution is everything. Look at what you have here. You have a management team whose entire professional background is in footwear supply chains and retail merchandising.
Right, they sell shoes.
Exactly. And suddenly they're attempting to pivot into the most capital-intensive, highly technical, and fiercely competitive infrastructure sector in the global economy.
It doesn't make sense.
It doesn't. They have to compete against trillion-dollar tech giants like Microsoft, Amazon, Google for highly scarce, heavily back-ordered NVIDIA GPUs. It is a fundamental mismatch of core competencies.
And there's a massive reputational shift here as well, which both The Guardian and MarketBeat heavily highlighted in their coverage.
Oh, absolutely.
Allbirds built its entire initial $4 billion valuation on being this hyper eco-conscious, sustainable brand. I mean, they were a certified public benefit corporation championing merino wool and carbon-negative materials.
That was the whole pitch.
And now they're completely dropping that public benefit status to build heavily power-consuming AI data centers. It's a total reversal of their founding ethos.
They explicitly stated in their SEC filings that the new corporate entity would be, quote, less focused on the public benefit of environmental conservation. That alone alienates their entire legacy base.
Yep.
But as fundamental analysts, we have to look past the ethos and focus on the math of the market reaction. Because the market did not care about the loss of the eco-friendly status. The market went absolutely euphoric.
Euphoric is an understatement. We are talking about a stock that was trading for literal pennies, suddenly surging 582% to close at $16.99.
Incredible.
And intraday, the spikes hit around 800%. The trading volume was astronomical, nearly 20 million shares trading hands, triggering multiple regulatory trading halts.
The market clearly loved the press release.
But if we look past the hype, what is this new company actually worth today?
Well, this is where we need to be ruthless with our analysis.
Yeah.
At a closing price of $16.99, the implied market capitalization of Allbirds shot up to roughly $150 to $170 million.
Wow.
Yeah. And just hours before the announcement, the market cap was sitting at around $22 million.
So in a single trading session, just by releasing a document with the letters AI on it, the market magically conjured up to $150 million of new equity value.
It's pure hallucination. Let's deconstruct that $17 price tag using the valuation models from Ticker X-Ray. We know, based on the asset purchase agreement, that the fair value of the existing footwear operation, the brand they are actually selling to American Exchange Group, is mathematically worth only about $1 to $1.40 per share.
Okay, think about this for a second. If the actual tangible shoe business is worth $1.40, that leaves $15.80 of the stock price completely unaccounted for by physical reality.
Right. That $15.80 is pure narrative premium. Retail investors are paying a $140 million premium for an AI business that currently has no revenue, no deployed capital, no data center experience, no engineering team, and absolutely no product.
It's nothing but a press release and an intention.
Exactly.
It is the equivalent of paying millions of dollars for an empty dirt lot in the middle of nowhere just because the current owner printed out a glossy brochure saying they might build a skyscraper there someday. It defies all logic.
It really does.
But Ticker X-Ray actually ran the forward-looking models on this. They tried to value the company assuming the pivot actually happens. Let's look at how they modeled the risk, because it's incredibly revealing.
Yeah, rather than just looking at the hype, Ticker X-Ray built out operational scenarios. Let's assume the base case. Management actually successfully raises the capital. They manage to acquire a small existing AI services business, generating $8 to $12 million in revenue, and they grow it at a healthy 40% year over year for 3 years.
Okay, so a solid success scenario.
Right. And even giving them a highly generous tech multiple of 5 times forward sales, the expected fair value today is still only around $4.50 per share.
That is the base case, assuming they actually succeed, and it still prices the stock over 70% below its current $17 trading price.
Precisely.
But what if they pull off a miracle? What does the absolute best case scenario look like?
Well, a true bull case requires flawless, almost impossible execution. They would need to raise $200 million without massive dilution, find distressed AI compute assets at a fire sale discount, and hit $60 million in AI revenue by 2028 with a 15% operating margin.
That's a tall order.
It's a massive order. In that utopian scenario, the fair value model is out to $29. But again, you are betting on a footwear management team out-executing entrenched cloud infrastructure players.
Which brings us to the scenario that Ticker X-Ray flags as the highest probability. The bear case. What happens when gravity kicks back in?
The bear case is grim, but it is the most rooted in financial reality. The company attempts the capital raise. deeply diluting the stock. They failed to secure the highly competitive GPUs at a profitable price point, they failed to generate meaningful enterprise revenue, and they simply burned through the cash paying out overhead.
So a slow bleed.
Exactly. In that scenario, the equity value inevitably drifts back toward 50 cents to $1 per share. That represents a 94% loss from where retail investors are buying it today.
Ouch.
Yeah, when you probability weight all these scenarios together, Ticker X-ray puts the actual mathematical fair value at just $3.80.
So if the math says it's worth maybe $4 on a good day, why on earth is the stock trading at $17?
That's the real question.
The answer is that this isn't fundamental investing anymore. This is pure market mechanics. When we looked at the data from FinViz, the setup was clear. Before this AI announcement hit the tape, the short float on Allbirds was sitting at 18.77%.
That is a massive metric, and it explains the entire rally. When a stock has nearly 20% of its shares sold short, it is a powder keg.
Just waiting for a spark.
Exactly. A sudden, wildly unexpected positive headline hits the market specifically, a headline containing the magic letters AI. Algorithmic traders and retail momentum buyers flood into the stock. The initial wave of buying pushes the price up sharply.
And that upward price action creates absolute panic for the short seller.
Exactly the mechanism. The short sellers, who are betting on the stock going down, start getting margin calls from their brokers. To cover their losing positions, they are forced to buy the stock back at market price.
Forced buying.
Yes. That forced buying drives the price even higher, which triggers more margin calls, forcing more short sellers to buy. It is a mechanical feedback loop. It's a classic short squeeze.
So it has absolutely nothing to do with mutual funds or institutional investors carefully modeling out future GPU leasing revenues.
Nothing at all.
And we haven't even touched on the most toxic part of the financing itself. People see $50 million financing and think the company just got a giant check deposited into their bank account. But that isn't what happened.
Right. Here's the real question nobody's asking. What are the actual structural mechanics of that $50 million facility?
Let's hear it.
It is convertible financing. An institutional investor is not buying common stock at $17 a share. They are providing debt financing that comes with the right to convert that debt into newly printed equity at a predetermined, usually highly favorable price.
Which means if the stock price manages to stay elevated because of this retail short squeeze, the institutional lender will just convert their debt into millions of new shares and dump them on the open market.
Precisely. They lock in a massive risk-free arbitrage profit.
Wow. So the resulting dilution will be staggering. The retail traders who are currently bidding the stock up to $17 are essentially providing the exit liquidity for the institutional debt holders.
That is exactly what's happening. The market is completely ignoring the fact that prior to this massive spike, the company had less liquid cash per share, about 25 cents, than the stock price was moving in a single minute of trading during the squeeze.
The multiple re-rating is just laughable. I mean, at $17, the enterprise value to sales ratio is roughly 1.2 times on their existing money-losing footwear revenue.
Right.
Historically, this failing asset traded at 0.3 to 0.5 times sales. The market has completely decoupled the stock price from the underlying assets.
So what does this all mean for the modern investor? We are looking at a tale of two absolute extremes colliding in real time.
It's wild.
It is. On one side, you have a fundamentally broken retail business that destroyed over 99% of its IPO value, failed to scale its direct-to-consumer model, and ended up selling itself for spare parts while its executive team safely cashed out with golden parachutes.
Yep. And on the other side, you have that exact same empty corporate shell miraculously resurrected as a high-flying meme stock simply by attaching the letters AI to its name and triggering a mechanical short squeeze.
Look, if you remember one thing from this analysis, it is this. You must ruthlessly separate market psychology from financial reality. A press release is not a business model.
Say it again.
A press release is not a business model. Until NewBird AI actually secures high-performance GPUs, signs enterprise clients, and proves they can operate profitably in the most capital-intensive sector in the world, you are not buying a technology company.
You're just buying a ticker symbol.
You're buying a very expensive, highly dilutive narrative. The fact that an empty corporate shell can conjure over $100 million in equity value overnight based on zero operational infrastructure, well, it's a glaring warning sign about the speculative fever in the market.
It is the ultimate cautionary tale, which leaves us with one final thought for you to mull over as you navigate this wildly unpredictable landscape. If a company that literally makes sustainable sneakers out of sheep's wool can instantly rebrand into an AI infrastructure firm, trigger an 800% intraday rally, and convince the market to hand them $150 million in phantom value.
Right.
Are we currently witnessing the absolute peak of the 2026 AI bubble? Because when gravity inevitably kicks back in and the music finally stops, who will be left holding the bag for a company that right now exists only on a piece of paper?